Section 7.1 in our textbook is health and life insurance. Insurance is protection against cost of loss. In this case, the protection against the cost of life of health or the cost of life. Health insurance provides protection against a portion of the cost resulting from an illness or accident. There are two types of health insurances. First, you have fee for service. These plans provide the insured, which is the individual or company receiving the insurance protection, which would be you, with complete control over health care decisions, but require high deductibles and or copays. Deductibles are an amount deducted from an insurance settlement, the amount of loss the insured agrees to accept. So however much money you agree to accept. And we're going to look at some policies and make that a little clearer. And a copay is a fixed payment made to a care provider by a medical patient at the time of service. So every time you go in, you pay a certain amount. The other type of health insurance is called managed care. These plans attempt to lower costs by focusing on preventative care and limiting choices. There are three basic types of managed care. You have an HMO, which is a health maintenance organization. That program has a primary care provider, which means you have to pick a primary doctor. That person will recommend you out to other people in their organization for specialized services if they're needed. Then you have a PPO, which is a preferred provider organization. That system allows you to, they suggest people to see, and if you want to see somebody outside of their suggested system, then you pay more to go, but you are still able to go to them. So that gives you lots of choice. Then you have a POS, which is a point of service plan. And they also require you to have a primary care physician. But unlike the HMO, the physician can make referrals to providers outside of the network. So these guys can provide you somebody that isn't in that system. All three provide access to their own network of healthcare professionals, hospitals, and clinics, etc. They differ in member control of choices, premiums, co-payments, and deductibles. Now, the premium, again, is the payment to the insurance company for the insurance policy. Your co-payment, again, is a fixed payment made to a care provider by a medical patient at the time of service. And the deductible is the amount of loss the insured agrees to accept. So this is how much you have to pay before the insurance company kicks in any money. So we're going to determine a monthly premium for an individual and a family using these two plans here. The employer pays $100 of the premium each month. So from Plan A, they have 100% coverage. Their annual premium for the individual is $19.50. So to pay monthly, you'd take that $19.50 and you would divide it by 12. That's going to give you $162.50. But then the employer pays $100 of that. So when you minus the 100, the person's actually going to pay, you would actually pay $62.50. Now, if you want a family, for the family coverage, you add $100. So that would mean I would take that $62.50 and I would add $100, and that would be $162.50 for the family plan. Okay, so this is the individual plan, and that's the family plan. So now looking at Plan B, they have a $500 deductible, which means they have to pay the $500 out of pocket before the insurance company kicks in. But along with that, they have an annual premium for an individual, which is $1,600. So to find out the monthly payment, you take the $1,600, you divide it by 12. And that's going to give you $133.33. Then I actually subtract the $100 the employer is going to pay. That means this person will pay $33.33 for the individual. If they want the family plan, then you take the $33.33 and you'd add $100 because the family plan is an additional $100, and that's going to give you $133.33, and that's the family plan. So that's how you're going to determine how much you pay for a health insurance policy per month. Then the out-of-pocket expenses are determined by what kind of events happen in your life. Okay, life insurance provides funds to your beneficiary. A beneficiary is a person or persons designated to receive the proceeds of a life insurance policy in the event of the insured's death. So whoever's getting your money after you die. Its basic purpose is to give financial protection to your survivors. There are two types of life insurance. You have term life insurance. This is limited to a specific length of time. So you can get 10 years, 20 years, 30 years. Then you have permanent life insurance. Permanent life insurance covers you for your lifetime or until you age out. So some of them will only cover you till you're 75 or 90 or whatever, and then they go away. The three types of permanent life insurance are whole life. Whole life insurance is a level premium paid annually until death. Then the face value of the policy is paid to the beneficiary. So if you get $250,000 in life insurance, then if you die, your beneficiary would get $250,000. So that's the face value of the policy. And you've been paying money, but you're not really getting anything out of it except that agreement that your beneficiary would get something. Okay, then you have universal life insurance. Universal life insurance takes advantage of higher interest rates and yields higher earnings on cash value of a policy. And from these universal life insurances, you can actually draw out money. You can pull cash out of them. So on page 265, there is a chart right here that basically talks about the different terms. So if you're under 21, this would be the amount of life insurance until you're 51 to 55, and it's going to be this amount of, if you're under 21, the amount of life insurance you might want to get is suggested here. And then if you're 30 to 35, these are the ages. This is the amount of insurance that's suggested. And then those are considered how much money you are paying. And they provide death benefits, which means when you die, you give them to somebody else. You can get those as well. Then you have a variable life insurance policy. It offers more investment options and therefore may create possibility of a higher rates of return. The problem with these both is they're an investment, and so as investments go up, they can also go down. So just be cautious if you're looking into that kind of a plan. So the formula for determining an annual premium is the amount of coverage divided by 1,000 times the cost per 1,000. That's going to be your annual premium. So we're going to determine the annual premium for a $200,000 policy quoted at $3.75 per thousand. So we're going to take the amount of coverage, which is the 200,000. We're going to divide it by 1,000, and then we're going to multiply it by cost per thousand. Well, the cost per thousand is $3.75. So putting all of that into your calculator, you're going to get that the cost of this policy is $750 per year. So this problems for this section, there are page 269 and 270, 1 through 29 odd. Please make sure you check your answers, and if you're having questions, send me an email. And then you're going to do the Excel practices, which will also be on the OneNote page. For practice 1 and 2, please make sure you're following the directions at the bottom, and then exercise 1 is the same concepts but without the directions. So make sure you understand the directions so you can follow them on exercise 1. And if you have any questions, let me know.